So by now you're familiar with the concept of paying off your mortgage faster in as early as 5 to 7 years using a line of credit such as a HELOC. But you might be in a situation right now where you have a low fixed rate mortgage at 4%, 3%, or maybe even lower, and you're wondering, does it make sense to use a HELOC at 6 or maybe even 7% interest rate to pay off my mortgage faster using the accelerated payoff concept? And you may have already assumed that just because the HELOC is at a higher interest rate, it automatically means that you have a higher cost when compared to the mortgage. But I'm gonna show you how with the accelerated payoff concept, that isn't always true, and how the HELOC actually could help you save even more money and time. By the way, my name is Sam Kwok, one half of the Kwok Brothers. I'm a certified financial education instructor, and I've been teaching this concept for nearly a decade, and my company is rated A+ on the Better Business Bureau and countless 5-star reviews on Trustpilot. And instead of this video just me talking, I'm gonna actually show you through Excel spreadsheets and calculators as to how a HELOC at 7 or 6% interest rate could beat your mortgage at 3 or 4% interest rate when using the accelerated payoff concept. Oh, and definitely stick around to the very end because I do have a special gift for you. All right, here we are on the Excel spreadsheet calculator on the accelerated payoff concept. Now, my gift at the end of this video is I'll explain how you could also get a copy of this calculator so that you can crunch your own numbers in and see the potential results. But for right now, let me go and illustrate how a HELOC at a 7% interest rate could pay off a mortgage at a fixed rate 3% and still could save you money and time in the process. So down below, to set the illustration, okay, to simulate our mortgage and our HELOC, here we are working with a mortgage, okay, so 3% interest rate, you can see right there, right? The original balance on this fictitious mortgage is, let's say, $400,000. Current debt balance of $375,000, so you paid some of it down or you had a down payment situation. And our principal and interest on this mortgage is $1,686.42. And yes, this is a 30-year mortgage like many of you watching this might have. All right, now down below is a section for consumer debt. We're gonna leave that empty for simplicity's sake. I wanna try to keep this illustration as simple as possible to ultimately help you understand the strategy. All right, let's say the start date is November 1st, 2025. All right, and really doesn't matter what date that is. That's just for us to use as a reference point so that we know when we could expect to pay off this mortgage. All right, our income expense. So let's say we are working with a net monthly income of $12,000. So that's the actual amount hitting our bank account. And our living expense, excluding the monthly P&I, is $8,000. Now, I'm gonna explain to you why we're excluding the P&I for just one sec. So the calculator will automatically factor the principal and interest payment along with our living expense as our total cash outlay for the month. All right, so here's our cash flow, and that's taking our monthly income minus our expense and minus our P&I payment. All right, now here we go. Finally, down below is our line of credit information. So we're gonna work with a $10,000 chunk at 7% interest rate. Now remember, we're not using all of the line of credit amount, right, that's given to us in the limit. We're taking small chunks of our line of credit and making a principal payment, principal reduction of our mortgage, which accelerates the amortization on that mortgage, thus saving us money and time. And because the way the HELOC works and the way that we're going to lower the average daily balance, we're gonna be able to save money and potentially beat the mortgage. So with the 7% interest rate on the line of credit using $10,000 chunks, here is our potential result on this simulation. So we could expect to pay this off by August 16, 2034. Remember, we're starting on November 1st of 2025. Okay, and we'll have this paid off in approximately 8.8 years. Our original interest, okay, this is the amount of interest that we would have paid had we not done anything new. That is the interest that we would pay if we don't do anything. That's the original interest cost of the mortgage moving forward. But because we are applying the accelerated payoff strategy using the HELOC, our new interest is down to $54,631.28. All right, and then right below, you'll see the mortgage interest savings of $118,621.55. And with the grand total saving for our mortgage is $118,621.55. So there you have it. It is possible to use a HELOC at a 7% interest rate to pay off a 3% interest rate fixed rate mortgage and still able to save money and time paying off our mortgage a lot quicker with less of a cost. So what I'm ultimately trying to demonstrate in this video is that the interest rate is not the end all be all, and the HELOC and a mortgage are two different types of loans that have different types of interest calculation being applied. And yes, both a mortgage and a HELOC use a simple interest calculation, but the main big difference between the two is going to be the timing of the interest calculation as well as how the balance is factored. Now, I'll have a separate video to really go deeper into what the differences are between a line of credit and a mortgage, and I'll leave that video link in the video description down below for you to watch as the next video. But just know that a mortgage and HELOC, while both are a form of a equity debt, both use simple interest calculation, the timing and the balance is going to be different in terms of the HELOC versus the mortgage. So let's go and shift a little bit and get into the under the hood calculation. So this tab right here, which I like to call the daily tab. Now this tab, the daily tab, shows you literally the day by day calculation of the balance, the interest, the cost, everything, how your income and expense plays a role in the strategy. Now, this tab is only available to our clients currently, so unfortunately, you won't be able to see it in the calculator that you download, but I'm gonna use this so that you can understand what is actually going on behind the scenes. So on November 1st, which is when we decided we're gonna start paying off this mortgage using the accelerated payoff method, we can see a couple of things that are happening all at the same time. First is that we're taking our $10,000 line of credit and applying it to our mortgage balance. So you can see an immediate drop from 375 to 364,251. Now, that's also further dropped by the principal payment we're making to the mortgage, and the mortgage balance is further reduced by the normal P&I principal payment that we're making on our monthly payment. So if we do the math, it's 375 minus the $10,000 that we applied from the line of credit, minus the $748.92 for the principal payment from our P&I. All right, and then what's also happening is that we also have our paycheck, $6,000, right? Assuming we get paid on the 1st and the 15th. So the total net monthly income is divided into two, $6,000 on the 1st and on the 15th. So what happens is that we have a balance of $10,000 line of credit because we borrowed the money from the line of credit and applied it to the mortgage. We have a $10,000 balance. So what we do with that $6,000 income is we apply it to the line of credit such that it lowers the balance on the line of credit, which then is subject to less or lower daily interest cost as opposed to keeping the balance high at $10,000. So as a result of that, you can see our line of credit balance the very next day is $5,686.42. And that balance is costing us an annualized interest rate of 7%. And so we need to calculate for the daily interest cost. And this is what we're getting, $1.09 that we're essentially paying every single month, as long as the daily balance on the line of credit stays at $5,686.42. So let's go and quickly manually do the math to show you how we got there. So we start with the $10,000 balance. We subtract the $6,000 from our income. So our income paycheck is being deposited into the HELOC. So the mortgage payment is being paid out of the line of credit as well, because, well, that's where all of our paycheck went into, right? So we're gonna go and add back $1,686.42. And there we go, $5,686.42 is our balance on the 2nd. So we just verified our Excel calculation. So this pattern continues where our line of credit balance stays the way it is until the next paycheck on the 15th, right here, okay? We reduce the line of credit, but because the paycheck is larger than that of our line of credit balance, we're gonna do another $10,000 chunk, okay? Take another $10,000 and apply it to our mortgage balance. So you can see the $364,251 mortgage balance dropped to $354,251. So we see a $10,000 difference, and that is reflected right here where the line of credit balance went up because we did another chunk principal payment to the mortgage. And subsequently, our daily interest cost has increased. All right, you can see that pattern there, right? And this will continue to where we got to pay for our living expense on the 28th. Okay, and if you're wondering why that is, check out some of the other videos. I'll explain why. I don't want to get into a rabbit hole in this video, but there's other videos that I created to explain why the daily expense comes out on the 28th and not kind of spread apart. All right, and so our line of credit balance goes up. Okay, so you can see our interest cost goes up as well. And so with most HELOCs, you pay the interest on the HELOC itself on a monthly basis. So what the bank/lender does, it takes the total interest cost, right? It takes the sum of all the daily interest costs and bill you pretty much at the end of the month, and that gets added back into the line of credit balance. So you can see the math happening there, where the balance was at $17,686, but we got our paycheck to offset the line of credit balance. We also have the mortgage payment that we got to pay out of the line of credit, and we're also going to see the monthly interest on the HELOC be applied to the HELOC itself. So we'll run that manually with our computer's calculator. Okay, so we start with $17,686.42 minus our income. All right, then we have to add back the mortgage payment, the P&I, $1,686.42, and then we also have to add our monthly interest for the HELOC itself. Okay, voila, there we go. It matches with our spreadsheet, $13,419.04. It's off by a penny. It's probably there's some rounding going on in there. So there we go. It's pretty darn close. I mean, yeah, off by a penny. And then this pattern continues. Income comes into offset. You pay your living expenses and your mortgage out. Monthly interest on the HELOC is being factored in. And this continues all the way till, right, where both mortgage and the HELOC are together paid off. Let's go to the very last row where we have value. There we go. So both the line of credit and the mortgage is paid off on August 16, 2034. And that's what we're seeing here in the potential results. So at this point, you're wondering, how is all this possible? Like, I still don't get it, Sam. I don't know how the HELOC is still able to save money and time, even though the interest rates might be much higher than your current fixed rate mortgage. Well, for that, check out the video that I mentioned earlier where the HELOC and the mortgage are different in terms of how the interest is calculated in terms of timing and the balance in which the interest is being applied to. So check out that video down below. And our channel itself has countless of videos explaining the different facets of the strategy. So definitely subscribe. And if you have questions, leave your questions down below in the comments. I do my best to answer every one of them, but also use your comments as inspiration to my future videos, gives me ideas to make more videos. So definitely leave your questions down below in the comment section. If you enjoyed this video, whether you had an aha moment or you're genuinely curious about the strategy, leave your thoughts down below. Of course, like this video for the algorithm, and we'll see you in the next video.